Tokens are broken. We just saw it with the 𝗬𝗺𝗺𝗀 token that was acquired by 𝗪𝗪 and rocked all its token holders. I mean, look at this chart. It basically went straight down to zero the moment the token acquisition was announced. So there are no token holder protections for holders out there. Another example is the Uniswap token. Despite Uniswap being one of the most profitable and revenue generating protocols in crypto, Uni token holders still to this day don't benefit and participate in the financial upside of the token. While the Uniswap Labs team earns all the revenue and the fees, as well as early equity investors, token holders get simply nothing. And another big issue with tokens or token launches are the so-called ICO rugs, where founders promise big things, raise a lot of money, but then don't deliver and rug the investors by taking the treasury with them, sailing into the sunset, or moving to Bali and living a cozy life there, pretending to still work on the project. But what they're really doing is just enjoying the life on the back of all these investors that gave them their money. And those are only a few reasons why we need better tokens, better ICO mechanisms, and better token holder protection if we want crypto and this entire industry to succeed. And that's exactly the point of today's presentation, where I would like to introduce you to Meta DAO and their novel mechanism of unruggable ICOs, ownership coins, and the new governance model that is called Futarchy. Alright, so without further ado, let's straight jump into this presentation. So what are the main issues with tokens and ICOs today? As I mentioned in the intro, these days revenue is not really tied to tokens, as we've seen with the Uniswap example. The team and the early founders, equity holders, are earning a shitload of money while token holders don't get anything. Another thing is that there is no token holder protection, as we've seen with the 𝗬𝗺𝗺 acquisition by 𝗪𝗪. 𝗬𝗺, a DeFi trading terminal, had a token, and the protocol itself generated something between 50 and 100k revenue a day, but still the fee switch wasn't turned off. But token holders hoped for future revenue participation, but then 𝗪𝗪 came in, purchased the 𝗬𝗺 team, and the token straight went to zero. So everybody that hoped for or invested into the team and hoped for future returns, they all got rocked as the token went straight to zero. And that's the main issue. Like, there is a general lack of accountability, since founders raise money and then all the investor money gets transferred to their multisig, which is usually held by a few core team members, but then this money is locked and basically they can do whatever they want with it. And the most common phenomena is called the slow Bali rug, where founders just take this money, go to Bali, work there 4-hour work weeks and pretend to work and to keep shipping while they are basically just chilling on the beach and pretending to work. Like, they announce new roadmaps, new partnerships, they are doing pivots just to please the market. They come up with new narrative, but in the end nothing happens, and those guys are living a cozy life on Bali while the token just keeps bleeding, going down to the frustration of all the investors. And then another drawdown of tokens these days is that there is no link between the token performance and the unlocks for founders and team members. I mean, the team members and the founders, they raise a lot of money initially, and that should provide them with some incentives, at least early on, to keep building out the project. And then over time, as we all know, tokens unlock for team members, but those unlocks should arguably be tied to the performance of the token. Like, what's the point? The token is down 90%, and then the team gets additional tokens on top of all the money they raised, which just further exacerbates the bleeding of the token. So there should really be a link between token unlocks and the performance of the token. If the token does well, then of course the team members and founders deserve to receive some more tokens. But if the token does poorly, what's the point to giving them any more tokens? Another flaw of today's token is that there is no built-in path to return capital. There are some examples that the token is down 80% from the ICO price, but the treasury is still 80% filled. So there is that clear arbitrage, but token holders cannot claim back their initial investment. So they're down massively, while the founders, they're still sitting on this massive cash pile and basically just chilling on Bali and doing nothing. And the final obvious flaw of today's tokens is that whenever they launch at a very low float between 10 and 20% and a super highly bloated, artificial, fully diluted valuation, which just contributes to the slow bleeding of those tokens going towards zero. So what can MetaDAO do to fix those issues with ICOs and tokens overall? So if you or if a founder launches a token on MetaDAO, then it's 100% a fair token launch. People from all over the world can participate in this launch, and there will be no low float, high FTV shenanigans. There are no hidden buckets of token allocations that are going to ecosystem funds, to the foundation, or some shady marketing and R&D expenses, which like community members don't really have insights into. And all the tokens that are issued to investors at TGE are 100% liquid and 100% unlocked. And this leads us to ownership coins that are rug proof, because all these tokens, they come with inbuilt legal protection. Let me explain you how it works. So every project that launches their product or their token on MetaDAO has to register a LLC, limited liability company, in a jurisdiction that comes with a DAO-friendly legislation like the Marshall Islands, Cayman Islands, or the state of Wyoming in the US. So founders, they have to sign a legal wrapper that binds the protocol's IP and all its off-chain assets to on-chain governments. So this basically means that token holders of this project or early investors, they become the beneficial owners of this LLC. So this makes the treasury unruggable, since every major decision that is being made on behalf of this project has to go through governments, and if the token holders don't approve it, the founders cannot simply run away with the funds, which is super curious. And how this is decided? It's decided by Futarchy, which is a market-driven governance mechanism, which is very novel and exciting, but more on that in a second. So let me walk you through the steps of how a token launch on MetaDAO works. So initially, if a founder wants to launch their product there, they have to introduce their project with a short one-pager. They describe what they're aiming to do, or they can also showcase an already existing project, along with a token ticker and the token symbol. Another thing that they have to state is the amount of money they would like to raise and their monthly burn rate. And then finally, they have to sign the legal wrapper, as mentioned before, that ties the protocol's ID and all its off-chain assets to on-chain government, so that founders cannot rug investors. And then, second step, the token launches. So there is a 4-day period where everybody around the globe that has access to the internet and to the internet capital markets can deposit USDC and contribute to this token launch. And only if the threshold is met, the token will be launched. And if there is more demand, then tokens will be distributed on a proportional basis to all the investors. And then as the funding period is over, tokens are being distributed to the community. So most of the times, or what MetaDAO proposes, is to distribute 100 million to the community, like everybody that participated in the fundraiser. And roughly 25% or 30%, like 2.9 million tokens, directly go into a liquidity pool, which is matched with 25% of the cash raised from the treasury to seed the initial liquidity for this project, so that folks that no longer want to hold this token or folks that missed out on the token launch can trade in and out of this pool. And additionally, if team members or if founders want to add a long-term performance-based incentive for themselves to keep building, they can issue up to 50% of the token supply to themselves. Like if you add this together, we have 12.9 million again, but they don't have to do this. And usually founders go with 20 or 25% just to give them an incentive to work a long time. But here the novel invention is that, of course, those tokens are locked at least 18 months after TGE, and they only unlock if the token does well. So how it works, those unlocks are split into 5 different tranches, and they only unlock if the price goes up. So if the price doubles or makes a 2x since after the ICO, then 20% of the tokens will be unlocked for team members. If they do another 2x, so they're up 4x, another 20% unlocks, and another 20% then unlocks at 8x, 16x, and 32x. So only if the project does a 32x from its ICO price, the founders will access 100% of their tokens, and of course only after a 18 months lockup period. So this perfectly aligns the incentives of the founders and team members with investors, which is pretty cool if you ask me. And yeah, here let's briefly take a look at Umbra ICO and use it as a case study. Umbra is a privacy protocol that is bringing incognito mode to Solana, and they launched their token on DAOs.fun. And initially, or like their minimum raise amount was 750K, but they ended up raising 3 million. But what is even more exciting here is that they did raise 3 million, but they could have raised $156 million. I mean, the demand was just staggering. So you might ask, why have they decided to only raise 3 million if they could have raised more than 150 million? And that's the beauty of Meta DAO. Because they, or the founders, they wanted to avoid buybacks or a liquidation proposal. Picture this. The team raises 150 million, and then, let's say 1 month after the token launch, the token drops by 50% and trades at an FTV of 75 million, while the treasury still holds $150 million. So now, through Futarchy, or their market-based governance model, token holders can come in and say, hey, listen, like the token is down badly. We want to liquidate part of our treasury, let's say 50 million, in order to buy back our token. And of course, that's not really what you as a founder want to see. If you raise all that money, that just half of it is being used to buy back your own token. Or alternatively, token holders can pull up a proposal to liquidate the treasury. Again, treasury is worth 150 million, token is only worth 70 million, 75 million, then there is a big arbitrage. So why don't we liquidate the treasury and get back the money that we initially invested into this product? So another thing that they stated is their monthly burn rate, which is 40K, which gives them a runway of over 6 years. So even though they raised 3 million, the only money that is directly accessible to the team is 40K a month, which is paid out by the protocol's treasury every month to the team. And if the team wants to increase their monthly burn rate, if they want to issue new tokens or expand the IP or do any other of extraordinary treasury expenditures, they always have to go through Futarchy, and the token holders and outsiders can decide whether that's a good idea or not. So in a nutshell, what is Meta DAO? Meta DAO is a launchpad for ownership coins and unruggable ICOs, and it's the first implementation of Futarchy in production, which is market-based governance. And now that we discussed what Meta DAO is, let's tackle the elephant in the room, and let me introduce you to Futarchy. So what the heck is Futarchy? Think of Futarchy as governance by markets rather than governance by people or token holder. So rather than asking the community whether they would vote yes or no for this proposal, we asked them what would be the token price of your protocol if this proposal goes through or if this proposal fails. And the outcome with the higher price then wins. If the fee switch is turned off, would the price of uni be higher or would the price of uni be lower? And then whatever market is traded higher, most likely 𝗧𝗶𝗺 on, yes, then the market should trade higher, then this outcome will be voted for. But yeah, let me give you an example with the famous Uniswap fee switch. So we all know Uniswap, the first AMM DEX out there, and until today they haven't activated their fee switch, but if they would, then in a Futarchy-based governance model, it would look this way. So there are two prediction markets. One prediction market tracks the price of uni if the fee switch was turned on, and the other prediction market tracks the price of uni if the fee switch is not turned on. And now token holders, but also outsiders, can come in and place their bets on these two conditional prediction markets. So let's say that the current uni price trades at $6. So you as a UNI token holder or also an outsider that never really liked the UNI token because you did not participate in the financial upside of the protocol, you could now say, I am willing to pay $7 and buy UNI for $7 if this fee switch was turned on. So automatically the price here would go up. So yeah, rational actors would just bet up this price here, since UNI token with a turned on fee switch is simply more valuable than a UNI token without the fee switch being turned on, and hence rational markets would price this outcome higher than the outcome of the fee switch not being turned on. So of course the UNI token price should go down if it's not switched on, because all the holders that are currently in UNI, they just they have some hope that the fee switch will eventually be turned on, but then if the proposal fails, we will most likely see a sell-off. So here, the markets decide that this is the better outcome, and then Futarchy would go ahead and turn on the fee switch. But with today's governance-based models, where token holders probably would vote for no, since early investors that hold the equity and all the team members, they probably don't really want to share revenue with token holders if they can keep it all for themselves. So it's somehow a minority which holds a large chunk of the tokens, so they would just artificially suppress the market and the fee switch would never be turned on. But on Futarchy, the beauty is that also external investors that don't hold any token can here play with these markets. And of course, I would like to own Uniswap. It's one of the most profitable businesses out there, but only if I, as a token holder, participate in the financial upsides. So now you might ask, how does it work to create a proposal on a Futarchy based governance model? So here, that's crucial. Anyone can create a proposal. You don't have to be a token holder, and proposals can be created that ask the following things: to spend USDC from the protocol's treasury, to issue new tokens, to update the token's metadata if we want to change the logo or the token ticker, and to increase or decrease the liquidity provided by the treasury. And what's key to note here is that even though anybody can create a proposal only moves on-chain for voting if 5% of the token supply is staked on this proposal. So this is just a mechanism to prevent spam, and token holders see, oh, this proposal actually makes sense, so I just put some tokens on it to affirm my conviction in this proposal. But this does not mean that those tokens are locked. You can just put it on the proposal and withdraw it at any given moment. And also tokens that are put on a certain proposal cannot be slashed, and there can only be one proposal live for a governance at a time. And then at the moment enough stake is put on a proposal, two conditional markets are created, like token price of LFG up or down if we vote yes, and token price up or down if we vote no. And then 50% of the spot liquidity, as we've seen initially, some funds get taken out of the treasury to seed initial liquidity. Now, throughout this 3-day voting period, 50% of the spot liquidity is taken to these two conditional markets to seed liquidity that everybody can trade these, can place conditional trades over the 3-day so-called voting period. And think of conditional trades like normal trades, except that they revert if the condition isn't met. And let's see how this works with a pretty simple case study. So here we have a case of a bet proposal. The treasury holds 10 million of USDC, and the market currently values this token at a market cap of 12 million. But then the founder shows up and he proposes to send all the funds of the treasury to his pocket that he can go to Bali. And then what happens? Overnight, as the news breaks, the market price immediately drops to 9 million, and these two conditional markets are spun up. So here, this market asks, will the token price go up or down if we let the founder run away with all the money? And here, the second market asks, what will be the token price of LFG if we don't allow the founder to run away with the money? I mean, in traditional ICOs, the founder doesn't even have to ask, they just take the money and run away. But here, of course, there is no way that the founder is gonna run away with the money, since governments has to approve it. So now please pause the video for a second and think about rational decisions or rational moves that you could make in this market. Cool. So let's suppose that both markets trade at $9 initially, just reflecting the market price. So you as a rational investor could now come in here and sell your LFG tokens for dollars in the case this proposal went through. So you are somehow hedging or protecting yourself, since of course if the treasury gets drained, then there is no value left and the token should be valued 0. And over here on the no market, what you could do is to buy more LFG tokens, like you put in USDC and you take out LFG tokens, because currently the market is valuing the LFG token at a 9 million market price, but we all know that the treasury holds 10 million, so there is a 10% arbitrage to be captured immediately. And as we see here, this market usually should go towards 0 pretty fast, and this market should go up towards 10. So the founder will not rock, and yeah, this market should trade up to $10, and then most likely a follow-up proposal will be spun up to liquidate the treasury, and this money is paid back. So you bought LFG for $9 and you will get it back for $10, and the founder, yeah, he rocked, he left, but he didn't take any money with him. So pretty cool. And now let's take a look at a second case study. In this case, there is a good proposal coming from the founder. And here we don't have a treasury, but let's imagine this protocol is generating 10 millions of annual revenue and the market price is 100 million. So this token trades at a 10x price to earnings ratio. And then like a beneficial founder comes in and he proposes to add a new business line to the protocol, which should increase the revenue of the protocol by roughly 5 million. I mean, he doesn't really state it, he just shares the proposal, everybody can read through it, and you as an investor, like we suppose that we think that this new business line will bring in additional 5 million in revenue to the protocol. Then again, two conditional markets are spun up. Will the LFG token go up, or like will the price of the LFG token go up or down if this proposal passes, and will the price of LFG go up or down if this proposal does not pass? And pretty obviously here the price should go up and the price should go down. But what's the beauty here of these markets? You always have to look at the current price, and usually markets, they just open at the current market cap. Let's suppose there are 1 million coins, so one LFG trades at $10. If you want to make some money on this market and you come in here and you see that the yes market trades at $10, what would you do? Again, please pause the video for a second and think about it. Of course, you would buy more of this token if you think that the revenue would increase by 5 million, theoretically giving it a market cap of 150 million, which would equal a token price of $15. So rational actors would bid up this market all the way until we hit $15 here. So of course, the first movers get the better entry price, then somebody else comes and sees this market trade at $12 and they would buy more. And then the moment we hit a price of $15, probably the buying should stop. But there are other folks in the markets that are super bullish and think that this new business line might increase their revenue by 2x or 10 million. They might even buy more and push the price all the way up to $20. And you then, as you bought it by 10, you don't have to wait for this proposal to end. You can always sell back your yes vote and just cash in the 100% profit you bought at 10, and you think that the overall market should be valuing this new proposal at 150 mil, but now it's currently trading at 200 mil, so you can just sell it back down to 15, and this natural mechanism leads to proper price discovery. And on the, like, you can, as I said, you can sell it back here, and on the other side here, let's say the no market trades at $8. Again, what would you do here? We would most likely buy, right? Because even though the proposal does not go through, we still have like the old revenue mechanism that should give it a fair value of 100 million, and we can now buy it at $8. So again, we can capture a little more than 20%. So it always depends on the market price here. But if it, of course, trades at 12, the no vote, this new business line wouldn't be valued, and hence it's overpriced here, we should most likely sell our LFG tokens and go into cash. And again, this mechanism leads to proper price discovery, and most likely at the end of the 3-day voting period, here the price should be around $15, and this one here should like remain at $10, since the business doesn't really change, just that no new revenue is added on top. I hope that these two case studies help you to understand Futarchy a little better. I know that there are a lot of moving parts and it's not easy to immediately grasp the core principles, but don't worry, it also took me a while to fully understand it. So yeah, just replay this section and watch it over again if it's not fully clear how it works. And then finalizing a proposal at the end of the voting period. By the way, this is a screenshot from Meta DAO. Here was a proposal to sell up to 2 million Meta at a market price or premium. So this is how it looks there. You see here the green chart is the yes vote and the no chart is the no vote. And whatever side has a higher TWAP, which stands for time weighted average price, at the end of the proposal wins. This is very important to understand. It's not the final price, because that could be manipulated pretty easily, you know, just a whale coming in last minute. But if we take the TWAP, then it's pretty hard to manipulate the price. And here the majority said, or like the yes votes said, if this proposal goes through, then Meta should be worth $6.25. And if it gets rejected, it should be only worth $5.90. Therefore, the proposal went through as the yes market won. And here you see the proposal was approved. So the approved market, yes market, has been finalized, and the reject market, the no market, has been reverted, and everybody that participated in this market can now claim their tokens. So this is basically how Futarchy works. And here just a quick slide why Futarchy works so good in crypto and especially fits tokens. Like, the idea of Futarchy has been around for years, but it has never been tried out in production. And Meta DAO is the first project that, doubled down on this idea and brought it to market. And it works so good for crypto because there is a clear objective function, which is the token price. All we do is to ask whether this proposal increases or decreases the token price. And we all want to maximize shareholder or token holder value. So only proposals that increase the price of the underlying token will go through, which is super brilliant. The second beautiful value proposition of Futarchy-based markets are that every decision is backed by participants having skin in the game, and this attracts highly informed participants that put real money on the line to participate in those markets, because if the market turns against you, you lose all of your money, which is not the case in current DAO voting systems. You just say, no, I don't support this proposal, and if it doesn't go through, there are no financial repercussions for you. And the third one is that bad ideas just generally get priced out, since nobody will put stake on it so that the proposal comes to a vote at the first place. And even though that a bad proposal should go through the initial seeding phase, like, rational markets would just downprice this proposal straight to zero, and there is no chance that such a proposal goes through, like the founder draining the treasury, which gives real protection to token holders, which is like the main invention of Meta DAO and Futarchy. So why should founders choose Meta DAO to launch their tokens with? Because first, you can get early retail support and just distribute your token to a very large community. So if founders don't want to raise initially from VCs and give like 2 or 3 parties a huge chunk of the entire token supply, Meta DAO offers an alternative. Retail people can buy in, and as we've seen before with the Umbra DAO, like, everybody could buy in at a valuation of 3 million. So that was the market cap or the FTV of this token when it launched, since 100% of the tokens are distributed, excluding founder tokens, which are like 20 or 30% of the supply. So sometimes this just raises massive opportunities for retail folks. And as we've seen with Hyperliquid and other success stories, if you have a core community of people that got rich early on, like Ethereum, Solana, so on, then they will just stick around and support you through the good and the bad times. Another benefit for founders is that they arguably attract smart and long time horizon capital. Like, investors will not be the typical pump fund snipers and, just short time horizon traders, since they know founders cannot rug them due to Futarchy. those investors have a long time horizon and they don't complain and attack founders like the typical trenchers do, so that might give founders some peace of mind. And of course, there is no low float, high FTV, as the tokens are 100% circulating and unlocked at TGE. And this is pretty cool. Tokens backed by Meta DAO should have a premium. Since all other tokens out there, you never know whether the team is rugging. I mean, let's again use the example of 𝗪𝗺, where the team raised 1.3 billion. But there is no legal binding and repercussions. If they just ran away with the money, they could easily take it, since the founders now hold this money. And there is always the risk of this rug, while Futarchy based tokens, or so-called ownership tokens, don't have these risks of founders just rage quitting, going to Bali, or pulling the rug. And another cool feature is that tokens launched via Meta DAO are mintable. Initially I thought, that's a bad property, but the longer you think about it, the better this feature becomes. Like, let's take the example of Hyperliquid. We all know that they have a FTV somewhere in the range of 40 million, which is like super high, and investors, they struggle a little bit to buy into this token. I mean, the market cap is 15 million, FTV is 40 million, and there are these massive token allocations that have to be predetermined before you launch your token, like the ecosystem fund or marketing spends or tokens that go to the foundation, which might actually never be used, but it artificially inflates your token valuation and potentially detracts or deters investors. And in the case of Meta DAO tokens, you can always issue more tokens later down the line if necessary. Let's say you want to onboard new investors, you want to do a series A, B, then you can ask community, hey, what about if we issue 1 million token and sell it to these guys? What if we issue 2 million tokens to hire new developers, to augment our marketing expenditure? And only then, if the community thinks that the token price will go up if we onboard this new investor, if we hire 10 new engineers, then new tokens will be issued, which is really, really probably the coolest invention that Meta DAO brings to the table. And Prophet, the co-founder of Meta DAO, describes it with the following words: Meta DAO is a place for crypto native enterprises to raise money that does not suck. And the benefits for investors are pretty straightforward. You no longer hold a wishy-washy, fluffy token, but now you hold a real ownership coin. And there is the treasury linked to the protocol that cannot be drained or rugged by founders, so you are not exposed to the typical slow Bali rugs. Furthermore, there is no quiet equity value capture like in the case of Uniswap and many other tokens out there, since the legal wrapper that was signed initially ties the protocol's IP, all the assets it holds, to on-chain governance. So yeah, there is no way that the founder sells IP rights or sells the treasury or does some shady OTC deals in the background. This is not possible at all. And yeah, you as an investor, you know that you are investing in genuine founders because they cannot rug you. And if they wanted, they would not launch on Meta DAO. They would just go somewhere else on 𝗪𝗺, for instance. So TLDR, why you should invest in ownership coins is to reduce the risk to get rugged. Of course, most startups fail, but here at least you eliminate the risk of being rugged. And just briefly, of course, like with everything else, there are always challenges and some risks. So one of the key challenges for Meta DAO is protocol liquidity provision that might lead to some shallow initial liquidity, especially for the conditional prediction markets, as the protocol seeds the initial liquidity, but of course also outsiders can come in and add liquidity to these pools. And then the participation in those decision markets or conditional markets is not like it's easy, everybody can participate there, but it's not super straightforward, as it takes some time for folks to fully understand the mechanisms behind it. Of course, there is regulatory risk, as with everything in crypto. Tomorrow these ownership coins might deem securities by the SEC. So yeah, that's another challenge or a risk to bear in mind. Another challenge is the adoption barrier. It really might take a lot for existing projects or DAO to move over to Meta DAO and adopt Futarchy. And arguably there might be some governance fatigue if there are just too many proposals that token holders have to vote on, or also external parties can vote on. But again, Prophet said that usually There should be 3 to max 4 governance proposals a year. Only extraordinary expenditures require governance intervention. And finally, let's take a look at the bull case and the vision for MetaDAO and Futarchy. So Futarchy native tokens, they should clearly accrue some valuation premium because, as we said so many times, you no longer run the risk of being rugged by founders. It introduces this permissionless, fully on-chain fundraising mechanism where anybody in the world, especially retail folks, can bootstrap new businesses, which comes with a baked-in investor protection, which is very, very crucial as it makes ICOs unruggable. So this arguably is the final state of internet capital markets, as it was always easy to raise money, but you never got the legal and technical protection as an investor. And the bull case for MetaDAO and Futarchy would be if well-established DeFi protocols and OGs like 𝗬𝗵𝘁 or MakerDAO that all have been around for years and generate real revenue would move over to Futarchy and hence signal to their token holders that they level up their token standard and have genuine interests in sharing revenue with token holders. And to wrap up this presentation, a final call to action to all the builders out there watching this video. Please consider launching a Futarchy native token to just level up the standards of our industry. Investors prioritize ownership, coins. I mean, now as I really dug deep into MetaDAO, it's hard for me to not invest in any other tokens that give me that kind of protection. I somehow feel bad, owning all these other tokens that can always like rug me, which is not a very pleasant feeling. And community guys demand unruggable governments and they switch over to Futarchy based governance. Alright, that's everything for today. I really hope that you got some value out of this, and if you stuck around until this point, kudos to you, you are a real DeFi native. In the second part of this presentation, we will take a deep dive into the Meta token and see whether it's a worthwhile investment, how they are able to generate revenue, so on and so forth. And as always, on top of getting early access to these videos, 𝗬𝗵𝘁 members can propose new tokens and protocols we should take a closer look at and do a deep dive research report. Alright, that's everything for today. Hope to see you the next time. 𝗬𝗵𝘁 out.